Imagine a single viral meme shaking the White House, sending shockwaves down Wall Street, and leaving global markets on edge. No, this isn't a late-night joke. This is the real-world ripple effect of the so-called taco trade, a phrase so catchy, traders and investors worldwide can't get it out of their heads. But what lies behind this meme is far more than internet humor. It's the story of America's latest trade war, a clash of egos, economics, and technology that's reshaping our global future. So, what exactly is the taco trade, and why has it left leaders, businesses, and ordinary people scrambling? To answer that, we need to zoom into the heart of today's economic battleground, the United States, circa 2025. The Oval Office is abuzz. President Donald Trump stands before the press, ready to defend his controversial tariffs. The room is tense. A reporter launches the question that's been lurking on Wall Street. What is your response to the viral taco trade meme? Trump bristles. "Oh, I chicken out? Isn't that nice? I've never heard that," he snaps, visibly annoyed. He demands respect from the press and insists his decision to slash tariffs on China and push back European trade deadlines was strategic, not weak. The taco trade, short for Trump always chickens out, is more than a jab. It's shorthand for what's become a Wall Street playbook. Bet on markets dipping after Trump's dramatic tariff announcements, then spike when he inevitably walks back, delays, or softens the measures. Traders rake in profits from this seesaw, but the stakes are much higher than a few clever arbitrage moves. Underneath the meme, a deeper question pulses. Have America's trade wars devolved into gamesmanship, risking not just financial markets but the livelihoods of millions? Let's rewind and unpack how we got here. For decades, the U.S. positioned itself as the champion of free trade, presiding over a global system based on open markets, multilateral agreements, and steady economic integration. Yet trade was never just about numbers. It was about political muscle and economic influence. Enter the Trump administration, pledging to make America great again by redrawing the rules. Starting as early as 2018, the U.S. imposed steep tariffs on Chinese imports, steel, aluminum, and later, a wide array of European products, citing security, unfair trade, and job protection. Each announcement drew swift retaliation. China slammed U.S. goods with reciprocal tariffs, the European Union filed formal complaints with the World Trade Organization, and American farmers, particularly in the Midwest, became collateral damage as soybeans and pork were left to rot. Still, the stock market adapted. Investors grew wary of political volatility. Every time Trump threatened a new trade crackdown, stocks would tumble. Yet, almost predictably, he'd backtrack. Deadlines for tariffs postponed, percentages reduced, exceptions carved out. Analyst Robert Armstrong of the Financial Times captured this seesaw with his now famous phrase, "The taco trade reflects a fundamental lack of commitment to consistent trade policies, undermining investor confidence." Soon, the taco trade wasn't just a taunt, it became a strategy. Traders began buying into the dips, confident that the president would soon chicken out and markets would recover. Bloomberg reports a 15% surge in trading volume centered on this meme-driven tactic. Speculation, not productive investment, started dominating the mood in both Wall Street and Main Street. Ironically, the policies meant to protect American jobs and industries boomeranged. The trade deficit with China climbed to $369 billion in 2024, a 5% jump from the previous year. Rather than stemming the tide of foreign imports, tariffs simply raised costs for everyone. The Peterson Institute for International Economics estimates Americans paid $80 billion more in higher prices since 2024. And the anger? It's not just theoretical. Gallup data shows Trump's approval rating on trade policies sinking from 45% to 30% in just 5 months. But the hurt runs deeper. Ford and GM, iconic American firms, have cited tariff costs as a major reason for shifting manufacturing out of the U.S. Instead of reviving blue-collar jobs, the protectionist crusade led to a corporate exodus, damaging hopes for a renaissance in American manufacturing. Gary Huffbauer at PIIE notes, "The benefits of tariffs are consistently overstated, while the costs, which include higher prices and reduced competitiveness, are systematically underestimated, harming the overall economy." The global repercussions are just as stark. The World Bank projects a 0.7% contraction in global trade volume for 2025, directly linked to these disputes. China's retaliatory tariffs now target over $120 billion in U.S. goods, punishing states that once championed Trump's tough-on-trade image. The European Union, their patience worn thin, files WTO grievances estimating $20 billion in annual damages, chilling the spirit of economic cooperation. Meanwhile, businesses of all kinds, from tech startups to family farms, have entered new territory. Unpredictability is the only constant. Joseph Brusuelas of RSM sums it up. Trade uncertainty depresses business investment, as companies are hesitant to commit capital when the rules of the game can change on a whim. How did it come to this? The answer lies in this politicization of trade, economic policy as performance art. Tariffs, once deployed sparingly and strategically, became power plays and bargaining chips. But as every poker player knows, bluffing only works if your opponent believes you'll follow through. As markets caught on, they stopped listening to the words and started betting on the walkback, a dangerous feedback loop where credibility erodes and chaos thrives. History is full of cautionary tales. The Smoot-Hawley Tariff Act of 1930, for example, famously intensified the Great Depression. Then as now, protectionist fever led not to prosperity, but to contraction, retaliation, and hardship. Yet in 2025, echoes of those missteps ring out, amplified by the internet, social media, and those ever-mutable memes. Kristalina Georgieva of the IMF doesn't mince words. Trade wars have no winners. They pose a significant threat to global economic stability, and their impact is felt most acutely by the most vulnerable economies. Skeptics argue maybe this is just tough negotiation, short-term pain for long-term gain. If the U.S. can coerce better deals, maybe higher tariffs today means stronger growth tomorrow. But so far, the facts tell a different story. Steel prices are up 9%. U.S. employment has fallen by 75,000 jobs due to the steel and aluminum tariffs alone. The one major exception, the USMCA, the successor to NAFTA, promises a 0.35% real GDP bump and 176,000 jobs, positive but modest, and with limited short-term relief. And yet, the legal foundation of all these moves is now under fire. Just weeks ago, a three-judge panel ruled that President Trump may have overstepped his authority by invoking the 1977 International Emergency Economic Powers Act to justify the tariffs. The administration has appealed, staving off immediate reversal, but uncertainty reigns. Could future presidents wield the same sweeping powers, or will the courts and Congress claw them back? For now, we're left with an uneasy stalemate. The taco trade meme continues to guide millions of dollars in trades every day, while the underlying policies deepen rifts at home and abroad. The IMF warns that protectionist U.S. policies could shave off a full 1% of global economic output by 2026, a figure that should make every policymaker and investor nervous. So, what comes next? Could the U.S. double down on protectionism, risking a prolonged trade war and further market fragmentation? Or will economic realities and public backlash force a rethink? And lurking just ahead, how might emerging technologies, automation, and new supply chain models change the entire game? The next moves will define not only America's economic destiny, but the very fabric of global commerce. As the world watches, one question remains. Will the cycle of tariffs and memes finally break, or is the era of the taco trade just beginning? But what happens next? With global markets in a state of uncertainty, legal battles over the tariff authority, and the viral taco trade meme shaping both market moves and political narratives, the road ahead for U.S. trade policy is anything but clear. As we look to the future, several key scenarios could dramatically reshape the global economic order and your wallet. Let's dive into the most likely futures, their risks, and their opportunities. Imagine a world where the U.S. doubles down on its current path. The administration continues to hike tariffs on major trading partners, China, the EU, even Canada and Mexico. Retaliation becomes the norm. China slaps even more duties on U.S. agricultural and tech products. The EU imposes new digital taxes, and emerging economies form new trade alliances that exclude the U.S. entirely. This isn't just a thought experiment. It's a scenario experts warn could fracture the entire global trading system. According to the IMF's Kristalina Georgieva, trade wars have no winners. They pose a significant threat to global economic stability. Recent projections show that if tit-for-tat tariffs persist, global economic output could shrink by a staggering 1% by 2026, enough to trigger a mild worldwide recession. American farmers, already battered by Chinese retaliation totaling $120 billion worth of U.S. goods, could lose international markets for a generation. Consumer prices would climb, making everything from smartphones to sneakers more expensive. And don't forget, the average American has already paid an extra $80 billion at the checkout since 2024 because of these tariffs. But chaos isn't the only possible future. There's an alternative, a return to multilateralism. In this path, a new generation of U.S. policymakers, feeling the heat from plummeting approval ratings and mounting legal setbacks, move to patch things up with partners and rivals alike. The U.S. re-engages with the World Trade Organization, joins new rounds of talks with the EU, and even seeks compromise with China on tricky issues like intellectual property and technology transfer. With more stable and predictable rules, global trade starts to recover. According to the Peterson Institute's Chad Bown, tariffs are taxes, plain and simple, and lifting them could give households and businesses much-needed relief. This scenario isn't just about goodwill, it's about dollars and cents. When the U.S. signed the USMCA with Mexico and Canada, it was projected to add over 170,000 jobs and boost GDP by 1/3%. While critics say these numbers are modest, they point to a key truth. Stability pays. Markets hate uncertainty. Investors, manufacturers, and consumers all benefit from knowing what tomorrow holds. A return to global cooperation could unlock new trade deals in Asia, Africa, and Latin America, and even help restore trust in the American brand. But there's another wild card in the deck: technology. We're already seeing automation, AI, and even 3D printing begin to hollow out traditional supply chains. If the U.S. pours investments into reshoring, bringing factories home thanks to advanced robotics, the very nature of trade could change. Instead of big container ships crossing oceans, imagine local production hubs custom printing your next car or refrigerator. On one hand, this could insulate the U.S. from foreign shocks, making the country more self-reliant. New jobs in high-tech manufacturing could emerge, and supply chains would be less vulnerable to geopolitics or pandemics. But it's not all upside. The shift could devastate low-wage factory jobs overseas, upend export-driven economies, and create new winners and losers at home. For anyone who remembers the impact of NAFTA or China's WTO entry, this is a revolution at warp speed. Economist Adam Posen cautions, trade policy requires a long-term strategy, not short-term political gains that disrupt markets and create uncertainty for businesses. If this next wave of tech-fueled deglobalization is botched, the pain could be immense, ranging from job losses in traditional sectors to a spike in global inequality. There's yet another scenario, a so-called managed trade regime. Here, the U.S. cuts special deals with a handful of preferred partners, setting import and export targets for everything from cars to microchips. This approach may seem appealing: control, predictability, support for specific industries, but history suggests it breeds distortion. Companies chase government quotas instead of market signals, efficiency falls, and global competitors look for ways around the rules. The result? More uncertainty, not less, as everyone tries to play a rigged game. So which path are we on? If you ask Wall Street traders writing the latest taco trade meme, the answer might be all of the above, depending on the headlines. The marketplace has gotten addicted to volatility, swinging wildly with every tweet, tariff threat, or lawsuit. Bloomberg reports a 15% surge in speculative trading volume as a direct result of the administration's flip-flops. Instead of long-term investment in factories or R&D, money chases the next big trade, a worrying sign for economic health. Amid this whiplash, what can ordinary people, voters, workers, even small investors, actually do? First, recognize that tariffs, even when dressed up as policy for the people, are taxes. They raise prices at the store, shrink the value of your paycheck, and can even threaten your job if your company relies on global supply chains. When you see political debates about trade, ask this: does the policy make life more affordable and secure for you or for a select few at the top? The numbers don't lie. The steel and aluminum tariffs alone raised prices by 9% and killed 75,000 jobs in the U.S., the exact opposite of what was promised. Second, look beyond the headlines. The taco trade meme may be funny, but it's a symptom of a real economic risk: policy unpredictability. As Robert Armstrong from the Financial Times puts it, the taco trade reflects a fundamental lack of commitment to consistent trade policies, undermining investor confidence. When investors and companies can't count on tomorrow's rules, they hesitate to build, hire, or innovate. That ripple effect chills the whole economy. Third, think globally. We live in a connected world, and what happens in Washington or Beijing doesn't stay there. Retaliatory tariffs from China have hammered American farmers, driving up bankruptcies and forcing desperate sales of family land. EU complaints at the WTO, demanding $20 billion a year in compensation, threaten to spark their own waves of counter-tariffs. Even if you don't export or import a thing, you're already caught in the crossfire. Fourth, if you invest or want to start, understand the new reality. Short-term bets on tariff announcements can work, until they don't. The recent surge in speculative trading volume shows that some are cashing in on unpredictability, but bubbles always burst. Long-term, steady gains come from stability and growth, not roulette with the headlines. Diversify, look for companies with global reach and resilient supply chains, and remember, political risk is now a fact of life. And if you run a business or lead a team, it's time to get creative. Many companies like Ford and GM are rethinking where and how they build products, moving plants outside tariff zones or investing in new tech. Don't wait for clarity, plan for volatility. Explore new markets, hedge your risks, and keep an eye on emerging technologies that could change the game altogether. But perhaps the biggest lesson is for voters and citizens. Trade isn't some abstract thing. It's about what you pay for groceries, your job security, and your children's future. As approval ratings on trade policy drop from 45% to barely 30%, the pressure is on politicians to offer real solutions, not just slogans. Ask tough questions. Demand accountability. Push for strategies that think beyond the next election cycle. So, to answer the big question, will America escalate protectionism or forge a new, smarter approach to trade? And can technology disrupt or even solve these dilemmas? Here's the truth. The answer is in flux. Right now, all the signs, ballooning deficits, global retaliation, legal battles, and public frustration, point to a turning point. The cost of chaos is mounting. Short-term wins at the bargaining table are sparking longer-term losses at home and abroad. Unless the U.S. makes a decisive pivot towards stable, cooperative, and forward-thinking trade policies, the disruptions will keep coming, and the taco trade will go from meme to mess. But disruption also means opportunity. If policymakers, businesses, and voters learn from the chaos, doubling down on innovation, investing in people and technology, and seeking common ground with allies, a new era of prosperity could be within reach. The lesson is clear. Predictable, consistent, and globally minded trade delivers real results. Uncertainty breeds only more memes, missed chances, and mounting costs. And here's a secret fact for the end. Did you know that historically every major U.S. tariff surge, from Smoot-Hawley in the 1930s to Trump's in the 2020s, has been followed within a decade by a wave of trade liberalization and booming economic recovery? The cycles repeat, but the outcomes depend on leaders willing to break the mold. So what should you do next? Stay informed, challenge the easy answers. And when the next big policy shift is at stake, at the ballot box, in the boardroom, or at your kitchen table, remember that the most powerful trade policy is the one that serves everyone, not just the loudest voices. Share this video if you've learned something new, and sound off in the comments. What do you think is the best path forward for U.S. trade? Should we protect, cooperate, or innovate? Subscribe for more insights as we track the next moves in the global economic chess game and reveal the strategies behind the headlines. Until